Hey there everyone, welcome to the second video class. This is the learning module number 2, the material CFA level 1. This module is a classic module, that's time value money. That's a module that I believe most of you are prepared for. Okay? Most of you have to, I imagine, right, have seen or know how to use pretty well the calculators, the financial calculators that you need for the exam. That's pretty much what this topic it's going to be about, right? To make sure that you really are comfortable, right? If you really understand how to use the main functions of your calculator, the ones that you chose for the exam. Reminding you that there are only 2 official calculators for the CFA exam. Choose the one that you feel more comfortable with and make sure that you know how to use it. Right? My takes on the TVM module from the CFA content and the exam. I believe that there are chances that you will see these questions, or maybe at least one question of TVM on your exam. All right. How do I predict that question to be? I predict that question to be on a timeline, time value money type of problems. Timeline, right? So the timeline, it's a very classic type of questions related to TVM. So that's the questions that you have to figure out some amount in the future, then figure out today how much you need to kind of put it on the side to make sure that you have that amount that you need in the future. That type of go back and forth type of problems, right? That's what we call the timeline. The timeline, it's something that really is really helpful, right? When you want to kind of like just to take a look on how to orchestrate, I guess that's the word here, I cannot remember another one, orchestrate that problem, frame that problem in a way that it's easy for you to understand what's happening, and then you can perform the correct calculation. Right? That's what I predict in the exam. Right? So what we're going to be doing here is just kind of going over some of the main or key points, the most important points that I selected here, and learning outcomes, and obviously examples. And that's about it, right? So it's not a long, it's not going to be a long video here. All right, let's go straight to the learning outcomes now. Right. So those are the learning outcomes here. Right? So again, first one, calculate the present value of fixed income and equity instruments. Let's stop. That's new, right? That's a new learning objective or learning outcome here. Okay, now it's not deviating from TVM. No, it's actually applying TVM to a specific point in finance, which is the valuation. Present value is the right to know the price of an instrument. I want to know the price of a fixed income instrument, or I want to know the price of a stock, equity instrument. Right? So I need to understand the concept of present value, because one thing that we need to start understanding, and don't worry if you don't get it much now, when you arrive on the specific topic, meaning fixed income and equity, we're going to talk about more how we come up with the price of those instruments on that when we arrive on those topics. Here is just the mechanic involved in the calculation of the price of a bond, fixed income, or equity, which is stock. Right? So that's the mechanic. That's how do you do the process, right? To find the price of a stock or a fixed income instrument, right? So we're going to see some examples. The idea here, it's very simple, friends. And try to understand that very simple idea, which is the premise of valuation in finance. What is the premise, right, of valuation in finance? That's all the benefits that you're going to get from that investment in the future, you should bring to the present and figure it out how much would be the fair price in the present to pay for all the future benefits that you're going to get from that investment. That's it. So if you're talking about a bond, what is the benefits that this bond's going to give it to me? The interest that the bond's going to pay me. What about the stocks? Well, the cash flows that the company will give, or the dividends that the company will pay, the stock. So I can use those benefits, and then I can discount those future benefits to the present, and then I know the price, the fair price to pay today. That's the basic premise in valuation. Okay, we starting. I think the CFA Institute now, when he redesigned the curriculum, right, of the quantitative, the topic quantitative methods, or he probably decided to already start touching, right, why it's important to know time value of money for the CFA exam. Answer: because you're gonna need to know how to find the price of instruments, and some of the process that we use to find the price of the instruments require time value money, require to understand present value, future value. Okay, that's it. All right, so don't get, for those that actually are taking the exam again, and so you saw in the previous year, you saw different learning outcomes, and now you notice, oh, hold on a second, this is very specific. Well, don't worry. The approach here is the following, and you're going to see this again. You're going to see this again when we're going to talk about decision trees. We're going to talk about the binomial pricing of an option. Oh, it's a little bit too soon to talk about derivatives, I know, but we're not going to be worried about derivatives. We're going to use as an example to understand the process of finding the price of an option using a tree. So I want you to get right away the mind frame that studying quantitative methods for the CFA exam will be learning techniques to understand how to solve problems in specific topics like equity, fixed income, portfolio management, etc. Right? Techniques. So learn about what was the video class that we did, the first one, right? Rates and returns. Well, so rates and returns. You need to know rates and returns. Right? You need to know the process, the types, how to calculate, the mechanic involved in calculating those rate of returns. Why? Well, because you're going to be needing for portfolio management. You're going to be needing, maybe not for level 1, well, but for level 2, especially level 3. So understand now this whole thing. It's not 3 different exams. It's one big thing. It's one big thing. And we're building blocks here. So we're right in the foundation now, the foundation of the foundation, which is the quantitative methods, basic points. It is the basic. Right? If you have taken statistics in college, you see that's how we start some statistic books right away. That's the starting point, right? And then it builds up. That's the idea here, friends. So we're building up concepts in knowledge that will be very useful in future topics. Now, does not mean that you're not going to face a question related to this in the QM session. But I think it's most likely that you're going to get something related to a specific topic at that topic. Right? Here you're going to be more in a generic way. They might use an example in your exam to ask you to perform time value money, but using fixed income, equity, options, etc. But the focus will be on the process, the mechanical process. Well, if you say the mathematical process to find the answer here, could be the price, could be the interest rate, or etc. Okay, there we go. All right, friends. So second, calculate and interpret the return or the implied return on the fixed income and growth of equity. Right. So what is the implied growth? Well, the implied growth is, look, I have this instrument has growing this much every year or every period. What is this average growth that I can get that's kind of like implied by those growth per period? Right? So we're talking about here like a geometric average, okay? Or something like some kind of average, but usually use the geometric average to get this intrinsic, right? This implied return on an instrument. A fixed income instrument, as you will see. By the way, parenthesis here. I might have said here a lot of words that might not make sense to some of you, let's say. Let's make that assumption. For example, bonds. I don't know if I mean, you should know. Yes, you should know because that's a prerequisite, kinda. A bond. What is a bond? But if you don't know what it is a bond, if you don't know how a fixed instrument, a fixed income instrument works, don't worry. We're arriving on the fixed income sessions and you're going to explain there, right? Knowing fixed income, it's not a prerequisite. At least that's not official, right? Prerequisite is economics, statistics, basic economics, basic accounting. That's how I classify the prerequisites for the CFA level 1 now. Right. But if there are some words that we're using here, options, right, or bonds, that you probably have heard about it but don't know much about it, don't worry. We are just using as examples, right? One of the things that I noticed on the change from this material now, the new curriculum of the CFA Institute started in 2024, it's that the content, the examples are very, very applicable to the financial market, right? The lessons, right? the learning modules are much more direct, right? And the examples are very focused on the market. I found it better, actually, to be honest with you. So the challenge that I can see might be the vocabulary for some of you. But if you go over this and you just can understand and say, okay, what I need to know is how to answer these numerical questions. I don't need to know much about the instrument now. I don't care much about fixed income instruments now, right? The features and etc. No. What I'm worried about here is using fixed instrument as an example, if I can perform the use, if I can use my calculator. That's the idea here. All right? Last one, the point C, explain the cash flow additivity principle in using calculating rates, option value, implied forward rates, forward exchange rates, and option value. First of all, I want you to take a look on the command word. It's explain. It's not calculate. So let's focus on the explaining part of it. What is the cash flow additivity? Is the possibility that you can add cash flows? Well, duh. But we need to go more than that. Well, you can only add cash flows that are happening in the same year or the same period. So if the cash flows happens in different periods, then what I do? Then I discount all the cash flows to a specific period, and then I can add those cash flows there. That's the principle of additivity of the cash flows. Now, what about the no arbitrage condition? No arbitrage condition, again, I believe it's a little bit too soon to talk about that, but the no arbitrage condition, you need to explain, right? You don't need to calculate here. So what is the no arbitrage condition? Is that, well, if the price of an asset in the future, right, or should be as expected, right? So, or let's actually rephrase that because that's not necessarily true the way I was framing here. See, let's frame it in a better way. Arbitrage opportunity is the opportunity of finding something, right, an asset, an investment, with two different prices, right, at the same time, being negotiated, right, different markets, let's say, at two different prices, the same identical thing. That should be an arbitrage opportunity. Right? But arbitrage opportunities in the financial market are like, I'll give an example here. Imagine that you're walking the street and then you see $100 bill or a large bill of your currency at the floor, right? And then you know what's going to happen? The moment that you blink and you open your eyes again or something, it's gone. That $100 or that 100 dineros, right? That 100 money that you see on the street is gone. Right, in a fraction of a second. That's arbitrage opportunity in an efficient market, right? It's just like, that's it. I blink my eyes, it's gone. But it exists, right? Arbitrage opportunity may exist, right? But the idea here is that when you're doing finance, when you're doing valuation, in financial valuation, then you must make some assumptions. Some assumptions will be, in this case here, arbitrage, free arbitrage, or arbitrage, no arbitrage condition. Okay, so just know how to explain that. It's a no arbitrage condition is that I cannot have this happening in the market. They have the same asset being sold by two different prices. Why would it be a no arbitrage What would be an arbitrage opportunity in that case? Well, or how would you, because this you need to explain also for future topics. So let's explain now. How can you take advantage of a arbitrage opportunity? You need a couple of things. You cannot put any money of yours. Don't take money from your pocket and put in that investment. That's not arbitrage free. Arbitrage free is the risk free. And you make money on that, right? And so you don't use your own cash. What do? So it's a borrow, invest, sell, pay back type of thing. So first of all, you borrow. Because then you don't use your own money. You go there and you borrow someone else's money. OPM, other people's money, finance. OPM finance. There you go. Then you go and you OPM this transaction. Good. Now you have the money. Good. Now what do? Now you're going to buy the cheapest one, right? And you're going to sell the most expensive one. Remember, it's the same item, it's the same asset, but one is more expensive, one is being sold at a higher price, the other one is at a lower price. So what do you take? I borrow, and then I go and I buy from the cheapest market, and then I will sell at the most expensive market, right? With the money that's not mine. So look at that. How lucrative is that? That's amazing. So I go there, right? How profitable, I should say. How profitable this is, right? Where you actually can borrow, not your money, take that money, buy something, immediately sell that for more, keep that extra in your pocket, and when it's time to pay back the loan, you have enough plus extra. That's the idea of a arbitrage opportunity, right? Now, like I said, it's like in a blink of an eye, those arbitrage opportunities will appear and disappear in an efficient market. Right? Now, this opens the door here for don't be careful with kind of those fake, I call fake in quotations, fake arbitrage opportunities. Right? That sometimes you see on the dark pools or things like that, right? Where sometimes the machines are trying to kind of like get in your attention, showing something, but then the moment that you're going to take action, it's already gone, right? Those type of tricks, that's not what I'm talking about here. What I'm talking about here is kind of like a really misspecification, that you can observe in two different markets. Then you can take advantage of that. That's arbitrage opportunity. And when we talk about finance, valuation in finance, we do not consider that arbitrage exists. Otherwise, it will be a little bit complicated. Right? Good. We're also talking about forward rates, right? Forward interest rate, forward exchange rate, option values. Look, it's too soon for us to do those type of calculations. The idea is how we do those calculations. Explain how those calculations are done. Then you're going to perform that when we arrive on forward interest rates. It's not a material heavy on level 1. That's going to be more level. The calculation is going to be more level 2, but you need to explain what implied forward rates are. Right? What are the forward exchange rates? Right? Things like that, because that's going to be very, very important on the topic itself. Talking about economics, we're going to talk about currencies. Then we're going to talk about the forward exchange rates. We're going to talk about fixed income. We're going to talk about the implied forward rate. But remember, level 1, I need to know how to explain those concepts. Level 2, I might have to perform some calculation. I have one implied forward rate. I have the spot rate. I have to find another spot rate. That's level 2. Okay, so one of the things that I like to do in my video classes or when I teach the material, the CFA, is to let you know, okay, the CFA material, is to let you know what that's going to be on the next exam. Because when you see the big picture and you say, okay, now I need to worry about this. Now, I need to prepare this very well, so when I arrive on level 2, I can understand better the concept there. That's important, right? But in the meantime, just understand here that the CFA likes to introduce, at least that's my strong educated opinion, that whoever writes the material likes to include something that you will see on the next exam. So just like to give you a taste, I guess, like to open the door, or if you study this and you learn, it's not going to be in your exam, but for the next one most likely will, well, that's fine. Right? It's not lost. So be ready. You will see some of the content here on level 1 that will be more applicable on the next exam. And I'll let you know. If I believe that's the case, I will let you know. Good. Which is the case of the implied forward interest rates. I believe that the calculation of the calculation of the implied forward rates given in spot rates are more level 2 type of questions. Okay, friends, so let's see the next slides, which I create some kind of key points for you, like a summary. Right? So the key points that we have there, let's well, time value of money on fixed income and equity. So I already explained to you. Think about benefits that the equity is going to give, stock, that the fixed income is going to give, bonds, and then learn that concept of discounting. So if I'm going, one bond is going to give me 100 dineros, man, every year, right? 100, 100, right? Well, I have to wait 1 year to get the first one, then another year, and the longer I wait, the less value that fixed payment will have. So that's discounting. I need to bring those values to the present. So what is the $100 1 year from now? What is $100 2 years from now? But etc. Right? Or if I want to use a different vocabulary here, how much can I buy, right? With $100 that I will receive a year from now, how much I can buy today with that? Right? What would be the equivalent, right, that I could buy? That's more or less the idea. Because think about inflation or think about things going up. So, and if the value is fixed, it's better to have 100 today than have 100 next year. So 100 next year is a little bit less than 100. And that's the idea that I want you to have in mind here when you're talking about discounting. Okay? Discounting future payments is bringing future payments to the present. Discounting, I divided by 1 plus the interest rate at a power of the respective year. That's the intuition behind discounting cash flows. We're going to see examples, all right? So this is just like, to kind of hammering the idea of discounting. But then I think when you see the example, most of you, if you're not getting now, you get it by that. Right. Equity instruments and time value of the money, fixed income, so already explained, implied return and growth, right? We already said that. What is an implied growth? Well, you have something that's growing every year or for a period. You want to know just like what is the implied average growth, for example, from that period of X years, right? That's that's what they call the implied return or implied growth, okay? And we're gonna have to kind of understand that for fixed income instruments, for equity instruments. Again, is just to understand, because when you arrive in equity, you're gonna learn about the dividend growth model, the famous Gordon model. Okay, just put that in the back of your mind if you never heard about that yet, because you will see. And you need to know for level 1 how to use the dividend model. Well, the dividend model use a growth rate. That growth rate, that's what we call the implied growth rate we can use for equity, right? We can use for to calculate the value of equity, the price of a stock, using a model called the dividend model, right? So right now on QM, TVM, Learning Module 2, we're just showing to you when you're going to use this mathematical logic to calculate or to solve a problem. So here we're talking about finding the price of a stock, right? Using elements. So what, like user intuition here, think about it, right? Okay, if I want to calculate the price of a stock, what do you think should be important here? So let's say, well, how much this stock's going to pay me? Good, that's the dividends. Good, selected that. What else? What is the risk involved? Great, that's how you're gonna require as a return. What else should be implied here? The growth of the dividends, the growth of the company. I should put that in the equation. And then I put everything in the blender, the growth, the return that I require, the dividends, mix it up, boom, I get the price of the stock, right? So here on Learning Module 2 is just a matter of understanding those topics, right? What they mean, what they really mean. Because you're gonna have to perform this in future topics. All right, what else? Point 6, equity instruments, implied return, implied growth, cash flow additivity, I already mentioned to you. That's very simple. It's adding the cash flows on the respective period, but not cash flows futures or past cash flows cannot be added, right? Interchangeably, I think that's how you pronounce. Number 8, implied forward rates using cash flow additivity. Okay, so again, if I have the cash flows, here 1, 2, 3, all at the present level, would I be able to find out the discount rate or the implied rate used to discount those cash flows? Of course you can. That's one of the beauty of TVM on the calculator, because on TVM you're going to have 5 functions. I'm going to show here to you: present value, future value, payments, interest rate, and periods, number of periods. There you go, 5 variables, right? Now, except for fixed income instruments that we're going to talk about later, normally a TVM problem is you just need 3 variables to find number 4. 3 to find 4, meaning if I have the interest rate, if I have the present value, and I have the time, I can get the future value. If I have the present value, I have the future value, I have the interest rate, I can find the time, and so on and so forth. So that's what we're talking about here. Number 8, implied rates using the cash flow additivity concept, right? That if I have the cash flows today, if I have the time, and I have, for example, the future value, the present value, any other variable, I can find another one. Right? We're going to see this as an example, right? And that's how you want to fix. And you get it. I think when you see the numeric example, you see exactly what I'm trying to explain here to you, okay? Forward exchange rates using no arbitrage. Hold on. We're going to talk about forward exchange rates in economics, because that's the material of economics. So forward exchange rate using no arbitrage, it's always no arbitrage in finance, so don't even worry about that word anymore. So it's just like forward exchange rates. How do I compute forward exchange rates? Now it's a little bit easier to digest what's written here, isn't it? There's no arbitrage. It's kind of like confusing. So forward exchange rate using, right? Using no arbitrage, forget about it. Just forward exchange rate. How do you calculate a forward exchange rate? How do I know how much would be the dollar per euro a year from now? Or how can I have an idea? Right? Well, I'm going to have to use interest rates. I have to use this concept. So here, you're going to kind of learn how to plug the figures in a calculator. But when you arrive in economics, you're going to understand the concept behind computing forward exchange rate. So we can wait until then, if it's the case. If some of you can wait until then. Okay? If you're kind of reading the text here, reading the material, kind of like, oh, this is a little bit too specific, well, then it's fine. But be ready, because you need to know, right? But you can wait until the topic, the specific topic related to that, right? More specifically, shows up. Then you can actually dedicate more time to learn then. But again, if you can make an effort and learn now, you'll be saving some time for you in the future. Right. In the option price using the cash flow additivity, so exactly the same. It's bringing the cash flow from the past to the present, and you can use that to calculate options. We're talking about here a very interesting or very, very useful model called the binomial tree model for options, which you're going to have to know, I suspect. Okay. Remind you, friends, there's several exams being happening at the same week. Right? You have a week to do level 1. So you can take the exam on the Tuesday, on a Wednesday, on a Thursday, Friday, Saturday, maybe Sunday in some places. So what happens, and you have 2 exams per day, right? 2 windows per day, morning and afternoon. So 2 different people can take the exam, one in the morning, one in the afternoon. Anyway, imagine the number of exams, different exams that we need to create. Therefore, any question, any point could become a question in the exam. So I could see a question about the option, the binomial option in one exam and not in another one. It's possible, right? Because you need to keep the integrity of the exam. They cannot be the same question. Otherwise, some people would have an easier way than others to pass. Okay? All right. I guess that's it for the key elements. So let's go to the points here. All right. Now we are on the learning module 2, my notes. Okay. So let's go very quick and show you. Right. Very, very, let's see here. 1 second. There you go. Let's see and show you the official calculators. I like the one that I use all exams, not, and I've been using for many, many years is the HP, but you can also use the Texas. So let's take a look. There you go. Those are the two calculators, right? So again, make sure you know how to use it, right? If you prefer the BA2 Plus, great. If you prefer the HP, great, okay? Just to make sure you know how to use it. You don't need all the functions, right? You're gonna need just few functions. I'm gonna kind of show here on the HP for you. See, for the first line you're gonna need here, if you divide the calculator in half, right? And you look here on the left side, the first row, you're gonna need it, okay? The last row, this third row here, I'm probably gonna need a clear only, right? And that's it. And the first two buttons here on the second row, you're gonna need it, right? The rest, forget about it. CHS for you to put the negative numbers, and I'll call your attention, and that's, I'm gonna make it even a little larger. Call your attention for the functions 8 and 9 on the 7 and 8, number 7 and 8 on the HP. The blue says beg, the other one says end, B-E-G-E-N-D. Extremely important to understand what this means. Beginning of the period and end of the period. You could be getting a question, or the payments into that account happens at the beginning of the period, and you have to set the calculation on the beginning mode, or the begin mode. If it's not, it doesn't say beginning of the period, says end of the period, doesn't say anything, then you keep the calculator on the end mode, right? And I believe is the same for the Texas B2 Plus, okay, or BA2 Plus. Again, I'm very much more comfortable explaining the HP because that was my calculator of choice, okay? And I tell you, it's not much that you need to worry about here. Right? I never like to use the storage recycle functions right here. I always got lost on those and end up like putting a lot of numbers in the storage, and I make a little mistake here and then everything's gone. I just used to be so upset when this happened. So in the exam, when I took the exam, I adopted the idea to take that piece of paper that they give it to you, and I'll keep calculating, and instead of putting the storage, I just quickly write the numbers. I know it would take a little longer for me to retype those, but I would feel more secure doing that, and I developed a method to do very quick, right? And it was okay for me, right? Remember, you have 1.5 minutes, my average, to finish the question, to answer the question. So again, if you develop a technique to do those typings, right, a little bit faster, then I suggest you not to use the storage and the recycle, because when you do too fast, you can make mistakes. All right, friends, I'm back here. All right, so I already said about the key points. I read about the calculator, the key points, the learning outcomes. So let's go and see some examples. That's the best way to understand the learning module number 2. Then what you do, go to the ecosystem, right? If you have access already to the ecosystem, and do as many questions that you can possibly find there. If you want to gain time, do it with the answers, right? Just click on the answers, read the question and see how it's done, kind of like mentalize or kind of like observe some patterns, and then imagine how this question could show up in the exam. How can I change this question so it would become an exam question? Because right? That question at the ecosystem, that when you find the ecosystem, it's not going to be in the exam. Don't even think about it. I know there are some exams out there which, if you study 5,000 questions, some of those or all of those or the majority of those will be in your exam. There you pass. That's not the case here. The questions for the CFA exams are unique, very unique, okay? So, imagine something like that. Imagine I create a question, right? And I put on this pile here. Then I create a similar question and I put on that pile. This pile here, right? This goes to create the ecosystem. This one goes to create the exams. Imagine that, right? That's how I would say, that's a mosaic theory. That's my assumption. I don't know if that's exactly how they do. I would say if I had to create a mechanism to create some kind of, to give the authenticity, to give the credibility that the CFA exam always had, right? The degree of difficulty of the exam, which is important, then you have to create some kind of mechanisms like that. So imagine that you don't know which exam you're going to get, or which questions you're going to get in your exam. Just imagine that anything that's in the official material could be a question. All right, here I have a timeline for you. Look at that. Timeline always have a present value, a future value, and maybe payments in between. Okay. Now, be careful with payments, because payments usually, to work well in the calculator, they should be equal payments. So be careful. Sometimes equal payments. If it's equal payments, then you can use the PMT function of your calculator. But if it's not equal payments, then you're going to have to use the net present value, the NPV function of your calculator. Okay. All right. Let's go here. So look at the 5 elements. Present value, future value, PMT, N or number of periods, rates or I, and the net present value. Important to remember that you could use the net present value to find the present value of different cash flows. All you have to do is set the initial cash flow, if you're familiar with the net present value, as 0. The CF0 is 0. And then you put all the other cash flows, put the interest rate, enter, and that value is the present value of different cash flows. So the net present value function on the calculator is very useful for that. All right. Now, if you want to use the PMT function of a calculator, make sure that the PMT is always the same. It only works if the payments are equal payments. Otherwise, it's not going to work. Okay. All right. I also stressed here the end and the begin. And I put here that, well, give me an example in real life where I'm going to have to worry about the calculator being on BGN or BEG. Answer, leasing contracts, lease contracts. Okay, contract or leasing, the first payment, it's always right at the beginning of the contract. That's something you need to know, but you will know when you arrive in financial statement analysis liabilities. Okay, because leasing or lease payable, it's a liability of long term. So when you arrive there, we're going to talk about more. But remember, I don't think you have to do that for level 1. You might have to do for level 2. If you have to calculate the value of lease payments, you're going to have 10 payments of 10,000 monies. How much is the present value of that lease today? You have to set the calculator at the begin mode. Right? I believe that all problems that will require you to set the calculation at the begin mode will be telling you at the question beginning mode, beginning of the year. The clue will be there. All right. Couple words here: annuities, perpetuities, multiple cash flows. Cash flow is different signs, right? And the rates of return. So here, okay, annuities, it's equal payments, right, for a certain period of time. Perpetuity, equal payments for an infinite number of time, but equal payments, right? So if I'm gaining $1 million every year, it's a lot of money. Well, it's good money, right? For some people, might be low money, but $1 million per year, decent amount, great for the first 10 years. But then after that, the $1 million is not going to be the same, right? It's going to be, it's going to kind of like, I'm not going to be able to buy as much. And then imagine 20 years later. So if we talk about perpetuity, don't get a little bit too, imagine that you're going to get millionaire or trillionaire. No, because it's fixed payments. And remember, if it's fixed, it loses value as you approach the future. So the longer you have to wait to receive the money, the less value will be. So it's important that you understand how an annuity works, how a perpetuity works. A perpetuity is like forever, right? An annuity is a fixed number of periods, right? Multiple cash flows, already said, different types of cash, different amounts, right? You use the net present value to answer those questions. Cash flows that change the signs, positive, negatives, okay? Sometimes some of the functions like the internal rate of return doesn't work, but I don't think this should be a concern here right now. The cash flow is different signs. Oh, this year I receive $1 million. Next year I pay 500. Then I receive 800. Then I pay 300. It's very unusual, right? Questions like that. But just bear in mind that if the cash flows change signs, right? Sometimes the calculator might act funny, right? Especially to calculate like the internal rate of return. But we're going to talk about that in corporate issuers. So just put that here as a hint. Rates of return we already talked about on the first video class. All right, friends, so let's see some examples, right? That's the best way, okay? So let's see. Practice example. Fixed income instruments, equity instruments, and the cash flow additivity. So let's see an example here. So look at that. The financial asset A pays the following cash flows for 5 years. 100, 250, 200, 150, and 80, all positive cash flows, okay? The asset B pays 3, 3, 3, 3, 3, and 103. Right? And find the price of those instruments using a required return of 12%. Well, what are you doing here? First of all, remember, you're going to have to use that technique I mentioned to you. All the future benefits should be discounted to the present to figure out the price today. So that's what I'm going to do here. I'm going to get 100, 250, 200, 150, and 180 on year 1, year 2, year 3, year 4, and year 5. So if I discount $100 1 year from now to today, discount $250 or 250 monies, right? 2 years from now, 200, 3 years from now, etc. And then I can add the cash flows, then I'll know exactly how much will be. Now, I put it here for you. Look at that. The first instrument, it's 100, 250, 200, 150, and 80. I need to know at T0 how much I should pay. So here I'm using the net present value. Even gonna turn it off. I'm going to erase and do it with you. Look at that. If I do the net NPV, I'm using Excel here, but you're gonna have to use your calculator. Excel is still not allowed in the exam. One day I hope it will. Excel is asking me here, what is the rate? The first variable, I put it there. So I'm gonna put 12%. Okay. Then Excel is asking me, right, after that, what are the cash flows that I will receive? Then I highlighted, right, all those cash flows here. Then I'm going to close my parentheses, right? And then I get 572. It's the amount I should pay today. That would be fair. There will be equivalent to receive 100, 250, 200, 150, and 80 with the risk involved equivalent of 12%. Right? And do the same for the next one. The next one, you're going to receive 3, 3, 3, 3, and then 103. Discount all those amounts at 12%, and you get $68. I got that using the net present value formula as well. There you go. Very clean, very neat. Right? Now, the question is, why did I use those two examples? What do they have to do with, look at that, fixed income and equity, right? The cash flow additivity you already seen. Well, the first example could be a equity valuation based on cash flows. You're going to see that on level 1, but more on level 2. Valuation using cash flow. So you calculate the cash flows, we call free cash flows, then you discount all those cash flows to the present, and that values, that's how much you should pay for the company. So that's an example here. That's an example of equity valuation right there. Second example is the fixed income. Look at that. It's always the same amount. Okay. What is this 103 on T5? 103 on T5 is nothing more, okay, than 100, we're down here, plus 3. That's what is 103. It's there. Okay. 100, it's every fixed income instrument, whatever you pay today, you receive at the end. So let's assume I gave $100 today, and then I received $3, $3, $3, $3 for 5 years, and then in the end, I receive my money back. So that's the 103 doing here. That's typical cash flow distribution, right, of a fixed income instrument, right? So we're already using as an example. The idea is not that you need to know details or concepts about fixed income instruments. No, the idea here is that you know how to use quantitative methods to evaluate the price of a fixed income instrument, which I just showed here to you. All right, next example, my friends. Let's see this one, second one. What do we have here? All right. Not very nice. There you go. I see why. Perfect. So look at it. Implied return, right? And implied growth. So I need implied return and implied growth. So let's see what I have here. Same examples. Financial assets A paying the same, financial asset B paying exactly the same. Okay. Let me actually make it more on the same line. There we go. So if asset A is priced at 500, what is the implied return? If asset B is priced at 97, what is the implied return? What is the implied average growth of asset A cash flows? Okay, so what is, first of all, let's say you need to explain those. Okay, so what is the first question asking? What is the second question asking? What the third question is asking? So take a look. Okay, actually I'm going to put this one here more close there because I want to make some use of this space here. There you go. So asset A is 500. What is the return? Well, look, okay, I need to know, okay, what would be the implied return on those cash flows here, okay, that I have. And that might be difficult, right, on the first case because the numbers are different, okay? So now, but you still could do it, right? You have the present value, okay, which you calculated before, right? We have the payments that are different. We just have to figure it out. What is that implied rate, right, that you're going to be there? We can do that using the IRR, okay? So you can use the implied rate of return when you have different cash flows like that, okay? You can use the IRR, called internal rate of return formula, okay? Then you set up there, put all the cash flows. In the first cash flow, you put 0, okay? And then you put all those cash flows there, right? And then you see how much would be that implied, right? That implied rate, right? That makes all those cash flows to go to 0, okay? That would be one way to see this kind of a implied rate, right? Now, if you had the price of the asset, which it is here, right? It was the asset price is 500. Then you can set the 500 as the initial cash flow. This is cash flow 0. That's how much you're paying. And then all the other cash flows, and then you solve for the IRR. Okay, that's how you do the implied return on the asset A. Now, what is the implied asset return for asset B? Well, for the asset B, you don't need to use the net present value because the asset B, the cash flows are the same. It's $3. Except for the last one, but the last one is not, the last one you're just getting your money back, right? So that's called the face value. So I kind of equate here for you, okay, the problem with the bond, okay? It's a fixed income instrument that's being sold at 97. It pays $3 or 3 dineros or 3 monies every year for 5 years. And the last amount called face value is $100, is the amount that you're going to receive in the end. So you have to equate that way, okay? And if you do so, and then you apply, put this in the calculator, make sure that the present value is negative, and then you solve for the I, and you should get 3.67 as the implied rate here, okay? All right. What else? And what is the implied average growth of asset A cash flow? So try to digest this question. What is asking you here? It's asking you this. Look, the cash flow is going from 100, then 250, 200, 150, and 80, right? So one way that I can do here, excuse me, is to compute the average growth per year. So look at that. It was 100 and went to 250. How much it has increased? And then from 250 back to 200, how much is decreased? From 200 to 150, how much it has decreased? And from 150 to 80, how much it has decreased? And then I can average those growth. Okay? So again, okay, the process here for quantitative methods, learning module 2, it's not really the vocabulary related to fixed income, equity, etc. No, it's the mathematical process involved to find returns, growth, and cash flows. Okay. All right, let's continue here. Let's see more examples. Okay, and by the way, all of those examples that you've seen here, okay, send, if you want a more explanation, send a message in the group. Now let's see, then we can do answer that in more details and show you more how to do step by step. We just don't want to kind of like consume time of the video here, just showing like every single one, right, step by step, right? We do the overall, we give you a couple examples. If you need more, you use the group for that. All right, let's see this problem here. Let me actually, oh, there we go. The numbers are not showing, but now they will. Okay, there we go. And the last one, there we go. Okay, so let's see this problem here. So this problem is the following, okay? Let's read it. Client invests $20,000 in a fixed income instrument today. It pays 3.5% yield to maturity. Again, don't worry much about the vocabulary, okay? Imagine this is an interest rate, but that's called YTM. It's something you need to know for fixed income. I believe the CFA institutes already, the CFA content is already throwing those words right at the beginning of your process. YTM stands for yield to maturity, is the interest rate on bonds usually. All right. So in this case, it is a fixed income instrument, correct. The investment, once you receive that money, you're going to reinvest automatically in a 2% account. So you receive 3.5% of 20,000, which is 700. You take 700 and then you immediately put in a bank account that earns 2%. I want to know how much money you're going to get in the end. Now, there you go. Yep, look at that. Now, be careful. Huh? The first 700, and you know it's all 700, right? 700, 700, 700. You're going to receive it 1 year from now. Consequently, you're going to invest on that bank account for 4 years. Remember, it's 5 years that we have here. Now it's 4. So you're going to have to invest for 3 years. Okay. The second 700, you're going to invest for 3 years. The third 700, you're going to invest, the second one, let's go again. This $700 you receive on year 1, okay, you're going to invest for 3 years because that bond stops on year 4. The second 700, you're going to reinvest for 2 years because you're going to receive on year 2, then you have 2 more years until the instrument matures. The third 700, you invest for 1 year. In the last 700, you're not going to have time to invest because once you receive it, the bond matures. So how much money do I have in the end? I just need to add, look, 700 plus 714 plus 728, 743. 743 is the 700 earned for 3 years, and the 700 alone here is the last one I received and I didn't have time to invest. Okay, then you add all of those and you get the total. Now, those are only the coupons invested. Okay, it does not include that 20,000 up there. All right, let's see one more example. Okay, now for the exchange rates. Okay, an option price using the cash flow. Again, we're just going to see the process here. We're not going to have much concern on the vocabulary itself. Well, look at the example here. We have 2 currencies here, right? The exchange rate of BRL, that's the Brazilian real, per US dollars. Okay, 4.8. 4.8 what? Well, you're going to have to know how to read this. That means that I need 4.8 Brazilian reals to buy $1. The one in the end, the one below the division symbol, it's the unit currency, right? The base currency. So it's how much of the one in the top I need to buy one in the bottom. Good. Now, question. If the expected annual inflation in the United States and Brazil are 5 and 8%, so United States is going to have inflation of 5, Brazil is going to have inflation of 8. Okay, calculate the forward exchange rate Brazil dollar, Brazilian real per USD 1 year from now. Let's stop. Again, this is what we're going to talk about now. It's going to be very important for economics. Okay, so think with me here. Okay? And you need, remember the prerequisites, friends? Now it's time for one of the prerequisites of economics to kick in. Which one it is? Well, is that if a country experiments inflation, the currency depreciates. Okay, so think about that. High inflation depreciates currency. In this case, the Brazilian real, right? It's 8%. The inflation of the Brazilian economy, it's 8%, and the inflation in America is 5%. So the Brazilian economy has high inflation, higher than America. Therefore, which currency will depreciate? Answer: the Brazilian real will depreciate, right? It's going to depreciate, right? So it's going to depreciate. So what does it mean that a currency depreciates? Think with me here. That's very important that you get this. Not for QM, for economics and more. Also level 2 economics. If you get this, you're going to be very happy with me when you get there, because you're going to remember me, say, oh my God, I'm glad I did the work on exchange rates on level 1, because now level 2, this is much easier to absorb. Guarantee that is going to cross most of you minds, most of the minds of most of you. Back here, think with me. If today I need 4.8 Brazilian real to buy a dollar, and the Brazilian real will depreciate, do you think I'm going to need to have more Brazilian reals to buy the dollar a year from now, or less Brazilian reals to buy the same dollar? And the answer, more. Because when the currency depreciates, you're going to need more units of that currency to buy the other one. Understand this? Good. Well, now identify that the currency has to go from 4.8, it has to increase. I'm going to need to spend more reals to buy the same dollar a year from now. How much more? The difference on the inflation. In this case, okay? The difference on the inflation is 3%. So the Brazilian real will depreciate 3%. Okay? So that means the more, just roughly speaking, right? Because we're not using any techniques here. I'm just using the intuition and the approach for you to understand. The Brazilian real has to go up, not the quote, the 4.8 has to go up 3%. So the answer will be that 1 year from now, you're going to need 4.944, okay, Brazilian reals to buy a dollar, okay? I'm going to put one more decimal here. So we have 4 decimals, because that's something that you're going to be need to know eventually, that currencies are always quoted with 4 decimals, okay? That's what we call the 10,000 approach. 10,000 equals 1 peep, okay? So it's in terms of peeps that we count the currency, right? The change. So 1 peep equals 1 divided by 10,000, which is 0.0001. Right? Just put that in the back of your mind. You're not going to need it for level 1, I don't think, but more level 2, I think you definitely will. All right, friend, one more. Now let's talk about the binomial method, okay, to find the price of stock. And that's going to be my last example here, because we covered everything that was on the learning modules, right? The learning outcomes, excuse me. All the learning outcomes we did at least one example of each. That was the idea. But again, now is the time that once you finish this video, you go to the ecosystem and you do as many questions related to learning module 2 there, to kind of like get a more broad idea how those questions will appear in the exam. All right, so let's see this one. You're gonna see that you're gonna need to get this logic here, because that's how one of the methods we use to price options. Level 1 will price options using the binomial model. Level 2 is gonna use the Black-Scholes-Merton model, for those that are already familiar with that model, or at least heard the name before. All right, let's see, friends. Let's see this example. The price of a stock today, times 0. That's not $0, but times 0. It's 100. It may go up or down 25% in value next year. So go up 25 or go down 25. All right, okay. Let's actually remove those numbers from here, because I don't want to, I want to solve that with you. All right, and let's see that one too. Goodbye. Good, so let's do it. All right, compute the value of a call option with a strike price of 108 expiring a year from now. Assume the risk-free rate 4.5. Right, let's digest the process of computing the call option here. But again, you will see, I promise, you will see this again on the video class on the option, on derivatives. All right, think with me. Good. So step one, see how much the stock is going to perform. Okay, so the stock's going to go, follow me here, right? The stock's going to go from 100, let's put it there, 100, and it's going to go up 25%, or it's going to go down 25%, right? So the stock's going to go to 125, let's say. Yeah. And the stock's going to go, let's say, to 75. Okay, there you go. Kind of like go up or down. Don't know, right? Because we just know could be the same, but in this case, we're going to have to make those assumptions are correct. Great. Now what? Now, pay attention. There will be a 25% chances of this to happen. The stock go up to 125, and we're going to have a 35% chance of the stock goes down to 75. But remember, I don't care. I don't want to know the price of the stock today, because I know the price of the stock today is 100. I want to know the price of a call option with a strike price equals 108. What is this? So if you don't know options, if you're new to options is not a prerequisite, so don't worry about it. You will see more when you arrive in options on derivatives. But since I don't know, and this one I have a little criticism on the material. I don't think they should introduce the binomial option model now, right? They should introduce you binomial trees, so learn how to do the trees, how to solve a tree problem, and then when you arrive in derivatives, we would show this. But again, let's deal with the official material the way it is. All right. If the strike price is 108, do you know what it means? It means that if the stock is above 108, then you can sell the stock, you can buy the stock for 108 and sell for that difference, for that highest price in the market. That's how we make money on a call option. But if the stock is below 108, then you're not going to make any money. This option will going to be exercised. It's not going to be exercised. It's going to expire. Great. So you can clearly see on the first case, right, that you have 125. So if you buy the stock for 108 and sell for 125, you made $17. So look what I'm going to do now. I'm going to replace that and put 17 there. But if the stock goes to 75, my call option, it's worth nothing, right? Because I'm not going to buy a stock for 108 when the stock is being sold for 75. So my call option expires worthless. Great. Now, how much is the price of the call option? Because see, right here, it could be $17 or zero 1 year from now. I want to know how much is the price of the call option today. So pay attention to what I'm going to do now. First, what is the probability of this the call option be $17? It's 65%. Okay, so 65% times $17 or 17 monies, right? 11.1. That's the value of the stock. Because look, how I solve this problem, the value of the call option at year one. How do I solve this problem? 17 times 65% plus 0 times 35%. That's 11.1. There you go, or 11.05. Then, is that the price of the option? Yeah, as the price of the option in year one. The question is, what is the price of the option at year 0? It's not 1105, right? You have to discount that amount to figure out what is the value of that number today. So what you do is you take the price 1 year from now, and you divide it by 1 plus the interest rate, which is 4.5%. Take a look right there, 4.5%. Okay. And that's the price of the option today, $10 or 10 money point 57. I'm going to round it with 2 decimals. There you go, friends. Okay? Not complicated, right? Not too difficult, right? It's maybe that'll be applicable for a high school type of question, if you think, right? And you can get one of those in the exam. Absolutely, right? It's a question that is showing a lot of knowledge here. You understand what is a call option, understand how to find the price of the call option in respective years, and you know how to bring how to compute the average and then bring to the present. That's a very interesting question, and definitely good chances to be in the exam. Okay, I guess that's it. That was my last example. The rest, the other one will be the next topic, okay, which will be learning module number 3. Good, I'm done here. So what I'm gonna do now is just kind of like conclude the lecture, conclude this this class or this video, okay. Just saying a couple things for you. It's not time for being discouraged. I'm not saying some of you are or not, but it's always to have not to make that assumption. If you are, be careful. Right? Don't do it yet. Okay, it's not time to be dismotivated, because you might be thinking taking the wrong approach here. Okay? If that's the case, meaning do the way I explain here in this video. Right? If the vocabulary is too heavy and it's too specific for a particular topic, like equity or options or fixed income, remember, what you're trying to accomplish on this learning module here is just that you know how to perform the calculations involved related to that, okay? Quantitative methods. So it's not yet required that you know what is a call option, not that you know how a bond behaves or what are the cash flows of a bond, nothing. What you need to know is, if those numbers are given to you, would you be able to solve that problem? Okay, and if that's the question that you answer as an yes, then you're good. You're good, and you can move on to the next learning module, right? Learning module number 3. Okay. Should I say anything else? I guess that's it. So again, right, this will be much more valuable, the lesson, if you practice, obviously, right? So do as many questions on the ecosystem, or if you have the book, the end of the chapter. And send in the group that we are in, send the questions that you have more difficult or you think they're challenge, and we can do it there for you. Okay. The next video class, the next learning module, is going to be statistical measurements of assets. Okay, focus on returns. And the next learning module will require some of the prerequisites of quantitative methods as well, right? You're going to have to remember normal distribution and some other concepts of probabilities, okay? But when you arrive on the next video, you'll see that all in details, all right? I'm ending this now, so good luck, keep studying, keep the motivation up, and then in the end, you're going to get that prize. All right, take care.